Hey everyone, welcome to this Friday edition of The Final Bar. Today we're going to talk about the overall market environment as we wrap the week. This is our weekly exercise to take a step back, look at how the markets have evolved from last Friday to this Friday. Choppy session, bit of distribution, technology still pushing upward and pushing to the upside. Cyclical is really struggling today with financials and energy on the downside, but a bit of a defensive flare with utility second from the top. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of the technical analysis toolkit. I've learned over my career, technical analysis is an ideal way to minimize the impact of behavioral biases in your own process, but maximize your ability to understand the investor psychology, the behavior of all the other investors and their collective behavior that aggregates into stock prices and ETF prices. We're going to talk today about some of the rotations that we've been observing this week. It's had a defensive feel to the week at times. You've seen small caps consistently deteriorate. We have rates coming down. We have gold struggling a bit. And we have some of the cyclical sectors, particularly energy, dropping off pretty good today, but also financials and some others. There are plenty of bright spots, though, and I think this is, I've mentioned a number of times recently. I would argue it's always a good time to be a stock picker because I think there are always opportunities to outperform if you know where to look and if you have the correct toolkit. But especially now, we're having a lot of choppiness. You're having the indexes do one thing, but a lot of individual stocks doing other things. It's a really good time to focus on how you're scanning for ideas, how you're generating ideas, and how you're interpreting trends. We have great guests on the show. I had a lot of fun with our guests this week, particularly Bruce Frazier yesterday with a very aggressive and bullish target on the NASDAQ 100, which was interesting to see. Coming up next week, we just have one guest for you. On Tuesday, we have Mike Zaccardi. Mike recently joined the StockCharts contributor crew. He's contributing a column on StockCharts.com through our Top Advisors Corner. We'll have him on the show next Tuesday. We will be taking Wednesday, Thursday, Friday off for the Thanksgiving holiday. Hope you guys are all able to celebrate safely with those you love, those around you. The week after that, on Tuesday the 30th, we have Sean McLaughlin and a lot of other great guests. By the way, if you missed any of our guest interviews, go to StockChartsTV.com. They're all on demand right there. Let us get to our Wrap the Week segment. And this is our weekly exercise to take a step back and focus on how the markets have evolved. Let's start with a poll, though. And this is an interesting one with a very not polarizing, I guess, very one-sided, I guess, is the way I would describe it. Which sector do you think performs better through year-end 2021? I thought this might be an even bet, between offense versus defense. Possibly, I've been banging the table on offense over defense so often that 87% of you are correctly saying I don't know if correctly saying, but are certainly picking up on the strength in the XLY. And only 13% of you more on the defensive side of the XLP. And that ratio of XLY to XLP, we review it many times on the show. It's called I call it the offense versus defense ratio. And again, analyzing that ratio came from the Fidelity chart room decades ago. One of my predecessors, Bill Doan, I spoke to him years ago. I was able to sit down with him before he passed away, unfortunately, talking about how they thought about sector rotation, particularly thinking about risk on versus risk off. And one of their favorite charts that they would use at the time looked at two indexes, which are no longer around, but it was basically this sort of idea. Now we have ETFs that easily track this relative performance of the offense over the defensive side of the consumer space. It is certainly favoring consumer discretionary and not just the cap weighted version. The equal weighted version recently broke out as well. So I would agree. I would vote XLY for sure. But again, what's great is the ratios, the charts will tell you when you need to start thinking a little more defensively. Let's keep on this process of wrapping the week. We're going to go next to our Wrap the Week chart, which is this one. So this is basically just looking at the returns over the course of the week. We start the clock last Friday, the 12th. We look at where we finished the day here today, and we'll just look at the returns in each of these major asset classes. We'll add Bitcoin here in a moment, which is certainly an outlier this week, and you'll see in a moment. But the S&P 500 finishing the week up about 1/3%. Came off a little bit today, not too much. And overall, it's just been sort of a slow and steady gainer. What's interesting is in that environment where the S&P is going gently higher in this week, you have energy stocks really pulling back, the XLE giving up after a recent breakout and stabilizing at elevated prices, kind of rolling over. And at the same time, you have semiconductors breaking to new all-time highs. And that's what makes a market, right? You've got a lot of different themes, different stories that are playing out. It's not just a macro call at this point, I would argue. A couple things outperformed the S&P this week. In red, we have bond prices. This is the TLT, which actually finished the week up 0.7%. Now, one of the stories that we've been talking about this week is the fact that rates, while overall fairly elevated relative to the where earlier this year, particularly over the summer, they're actually coming off a little bit, and that means bond prices are going higher. So outperforming just a little bit given today's strength. The dollar index up about 1%. That's using the UUP, and the big winner for the week, the QQQ, the NASDAQ 100 ETF, up almost 2.4%. We're going to look today in particular about that idea of growth over value, technology going higher while other things are not. That is certainly a theme to be focused on. What underperformed the S&P and all these other ones were actually down for the week. Gold prices down 1%. In orange, we have emerging markets down 2.1%. In purple, small cap stocks down 2.8%. At the very bottom, crude oil down almost 4%. And those last two certainly, very important themes, because we've talked about energy prices going higher. We've talked about the pullback that we've seen over the course of this week. Small caps going lower as well, and the small cap indexes tend to be a little more skewed towards things like financials and cyclical sectors. So when rates go up, those tend to do fairly well. When rates come back down, small caps in general tend to underperform, and that's sort of what you're seeing play out here this week. Now, if we add Bitcoin in the mix, we didn't show it on our first graphic, but we add Bitcoin here, and you can see that it was really down fairly significantly. Jumped up today, and all the cryptocurrencies are up just a little bit, as we'll see here in a moment. But Bitcoin shedding about 10% of its value just since last Friday when we did this weekly wrap segment. So, as I mentioned with cryptocurrencies, I think what you have to remember with cryptos, there is potential for certainly incredible reward, particularly in some of the altcoins. I've talked with Dave Landry, one of our fellow contributors, many times about altcoins and some of the potential movements there, some of the opportunities when, Dogecoin starts rolling over and people are asking about Shiba Inu. We've looked at a lot of those. And the challenge, I think there's a potential benefit, there's a potential reward there. Absolutely. Is there a chance to, have incredible returns in a short time frame? Absolutely. But what investors have to remember, and traders especially would know, is that with great potential reward comes great potential risk. And you're seeing that on a week like today when you're losing 10% of your capital if you bought Bitcoin a week ago. Having said that, right, a lot of those coins are still fairly strong and a fairly solid structure. This could be just a pullback of sorts, but we'll let the charts tell us the stories. Just real quickly, because I missed just some of the movements today. The S&P just below zero really was a choppy sideways day for the most part, but a familiar theme to this week, which is the Dow lower, the NASDAQ higher, which is what we've seen. This is sort of that growth over value trade. And the ratio, we'll look at growth versus value a little later today. You see it's really favoring growth recently. And again, I think that's an interesting thing to pay attention to. A lot of that is driven by strength in technology. And we've talked many times about semiconductors. You have things like, Micron up 8% today with some strong movements, in NVIDIA having an incredibly strong week and elsewhere. Very quickly, the VIX is actually higher today, up just under 18. Other asset classes very quickly, as I mentioned, interest rates coming off a little bit. 10-year yields finishing the week around 154. That's down from above 160. It was up to almost 164, 165 earlier this week, if I remember right. So it's certainly come off here. And the dollar index up 0.5% from yesterday using the UUP. Commodity prices overall relatively mixed, but in general a lot lower, with gold and silver both down 0.75 to 1%. Oil prices using the USO down pretty significantly, above 3%, and the energy sector the worst performer of the group. Quickly on cryptocurrencies, all in the green. Yesterday, this entire page was red. Today, it's all back green. That is sort of the nature of this market. You get big swings on both sides of it, but interesting to see some of these coins recovering from fairly low levels. Bitcoin actually hit 56,000, just below that overnight, but rallying back to be just below 58,000 now. Ether having a nice V-shaped move to the last 2 days. Finished yesterday, we were recording the show around 4,000, currently just above 4,250. Sector-wise, I wouldn't say it's all growth over value because it's a mix of things. You have utilities number 2, which is a fairly defensive sector and very value oriented. Cyclical the fourth one is cyclical sector and materials, which was down just a slight bit, and consumer discretionary up 0.4%. I think the big stories here: leadership from technology, continued strength from utilities, which a lot of people would consider a little unusual, but I would argue that the trends are what you need to follow more than anything, and the weakness in things like energy and financials. Let's finish our Wrap the Week segment looking at the Mindful Investor Live chart list. You can get to this at any point. By the way, it's a list that I maintain. Go to the articles tab, go to my page called the Mindful Investor. There's a gray button at the top that says Live Chart List. That'll get you right to this point. We'll start with the market trend model. I look at the market on a weekly trend analysis and basically do 3 time frames: long-term, medium-term, and short-term. And this is a way I've designed years ago just to track the different time periods and get a general sense of where things at. And really, with my goal with this model was to create a model I could apply to a lot of different asset classes. And that's where I found it to be really helpful to know at a glance what's working and what isn't. And in terms of what's working, the S&P certainly would be a thumbs up on that, with the long-term, medium-term, short-term models all remaining very positive. They've all been positive now for the last 6 weeks, and overall tells me to think about 3 things. Number 1, to identify breakouts. When the market overall is doing well, you want to look for stocks that are breaking out and show opportunity for future upside. Number 2, stick with the trends that are working. This is not a time to be unwinding from things that have been working. It's time to lean into those and wait for the markets to tell you otherwise. And that's the third thing I would say, is look for when look for potential signs of weakness. And this week, an example of that would be the weakness in some of the cyclical sectors. Certainly something I'm paying close attention to. The next chart is just a daily chart of the S&P. We talk about this most days on the show, so I don't want to belabor it, but just remind you, I've highlighted 2 of the key areas that I think would be important. I always try to update support and resistance levels as the markets evolve and think about what levels may be meaningful given the dynamics that we're seeing. The fact that we broke above 45.50 in mid-October and now have stalled just a little bit, last 2 weeks, right, are sort of stable. It's been about 2 weeks since we made a new intraday all-time high on the S&P. So 45.50, and I would say the 50-day moving average not too far below there. That's your first level of support. That's your first line in the sand. We remain above that, and even on the short-term time frame, the market is still fairly strong. Below there, 4,300 lines up with the lows from September and October, also the 200-day moving average. That would be the ultimate level of support. And again, that's pretty far away, right? That's another 400 points. That's it's a 10% drop from, sorry, that's not right. About an 8% drop, we'll call it, from where we're at right now. So, a decent pullback from current levels. But it's worth noting, remaining above there and overall structurally on the long term, the trend is still fairly positive. We break there, you'll hear my voice get a lot less positive on stock prices. Breadth measures overall still fairly strong, and you've seen over the last 2 months that the 80 lines have all been trending higher, coming off going into the weekend here, which is an interesting thing, I think, to pay attention to. Now, next week is the Thanksgiving holiday. Shortened holiday weeks tend to be fairly sort of flat to positive for stocks. It's rare you get a big distribution phase in a holiday week. It tends to be a little more optimistic, and December would be the time when you may have an opportunity to to get further directional change in the markets overall. I would say if past is any guide. However, I think it's worth pointing out today, you're seeing most of these go higher in the last 2 months, but it's worth noting the NYSE 80 line still hasn't gotten above the June high. The small cap 80 line, same thing. These are actually both bumping up against that level from June. I still see these as fairly positive, having had a nice trend in the last couple of months, but certainly something to pay attention to. A bit of a drop in the percent of stocks above their 50-day moving average. About 10% of the S&P, it looks like, in the last week or so have gone from above their 50-day moving average to below. That's actually an interesting one. That's a non-zero number of names that have rotated lower. However, this remaining above 50% tells you conditions are fairly positive. If you look at the times when it's gotten below 50%, those are the periods of a little more corrective, where you have to be a little more cautious about potential for the downside, because what that tells you is a lot of names are starting to break down. We're not really seeing that just yet, maybe just the beginning of something here. This is an interesting chart. You know, I was writing a note for my premium members earlier today, and I was thinking about some places where there could be potential issues. And this was one that we talked about, which is basically the market has not really made new highs here in the last 2 weeks. The number of new highs on the New York Stock Exchange has actually been sloping downward. So less and less stocks making new highs, kind of stalling out, similar to what the market is. And what's interesting is you only have 35 stocks making a new 52-week low. That is not a lot. But if you look back, this is one of the lowest readings, if not the lowest reading we've had so far year to date in 2021. Now, in deeper moves, you will have a lot more red on the chart. February, March 2020, go back to there and you'll see plenty of distribution. So it's not much yet, but it's certainly something to look. If you see less and less green and more red in the coming weeks, that will tell you to be less and less optimistic about the market environment. We talked about sentiment yesterday, so we'll keep going past. And with a minute we have left, I'll see how many of these ratio charts I can get through. Offense over defense, consumer discretionary over consumer staples. That has been the theme. I don't see a reason why that's changing. The second thing, second ratio would be the semiconductor relative performance. This is breaking out to a new multi-year high this week. And what's interesting is the ratio of the SMH to the SPY. Semiconductors tend to be a good bellwether group. That group tends to do well when market conditions are strong. And overall, it's hard to find an industry that's doing better on a technical basis, I would argue, here in recent months than semiconductors. Small caps versus large have sort of stabilized a bit. There's this nice rally where small caps are outperforming. It's come off a little bit in the last week. That's certainly something to look at, to follow looking forward. Also, the eco-weighted S&P versus the cap-weighted S&P has broken down, and they made a new 6-month low this week. So what that tells you is basically within the S&P, which is basically mega cap, large cap, and a little bit in the mid cap space and not much. It's basically saying you that smaller end of the S&P is underperforming the larger end, is the way you can generally interpret that. And that makes sense if you have some of the growth sectors outperforming, because there's a lot more cap in the growth-oriented sectors like tech and consumer discretionary. So reasonable given the strength in those places, given rates coming off this week, that you're seeing the equal-weighted S&P underperform the cap-weighted S&P. Let's take a quick break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close. As we focus on the charts, we focus on the markets together using the technical analysis toolkit. A couple of quick announcements before we open the mailbag. First is the way we get questions is from all of you sending us an email. Let us know what you're running into as you're analyzing your own charts. What questions are coming up on technical analysis, particular indicators, particular stocks or ETFs that you're scratching your head on. Anything we share on the show is fair game or elsewhere. Our email is thefinalbar@stockcharts.com. On Twitter, just tag us in a comment at FinalBarSCTV. On YouTube, put a comment below the video you're watching on our Stock Charts channel. We'll gather all of those questions. We'll hope to answer one of yours live on the air in our next mailbag segment on Tuesday's show of next week. Also, go to StockChartsTV.com. That is our on-demand platform. We had great guests this week. Bruce Fraser, a lot of fun talking about point and figure charts. We had great discussions about market dynamics. Javed Mirza talking about the long-term S&P cycle, much more, special events, and all of that at your fingertips. Go to StockChartsTV.com. You can also search on any of your mobile devices on the App Store for Stock Charts TV on demand. Let us open the Final Bar mailbag. Again, all these questions have come from you guys in the last couple days. Excited to hear from you. And let's get to the first question. As of noon, 11/12/21, 22 Dow Industrials are at their 52-week high. The RCD to RHS, that's the consumer discretionary to staples equal weighted ratio, and SPX to TLT, that's stocks versus bonds, are above their 200-day moving average, but there are only 13 new S&P highs. Your thoughts? So interesting, I looked at this question earlier, and I'm looking at the Dow 30, and I don't know if you were referring to a different index, but if I look at the 12th, which is actually, if you see this kind of faint gray line here, which is kind of a decent update for stocks, just to the left of there, that would be the 12th. And I certainly don't get 22 out of 30 of these. I see maybe a handful that are at new highs, but most of them are kind of just a little bit off off their high levels here on the 12th. So I'm not sure what you were looking at. Are a lot of stocks very close to their all-time highs? Absolutely, that's undeniable. But I think what you have to remember, and the question is, are there only 13 new S&P highs? But you have to remember when you're looking at new highs and new lows, that is literally a daily reading. So you're going to have certain days if there's, if the market overall pulls back a little bit. Here's the new highs list, and this is the 12th here, which is that number you're referring to. So overall, on the days surrounding that, there are a lot more. That was just one of those days when everything kind of pulled back a little bit. The market was off, and as a result, very few stocks were actually making a new 52-week high that day. So you have to be a little careful looking at one specific observation and drawing a broader conclusion. And that's why I often will look at the trend. Over time, are the new highs expanding or contracting? And so that's why I tend to look at these over time. And I talk about you want an expansion in new highs. That means over time, more and more, you're going to have these little blip days where there's more or less, but overall, what's the trend, right? Can we smooth those out and just look at the overall trend in those new highs? And it's worth noting, right? Some of those ratios, I would argue, consumer ratios still very much favoring consumer discretionary. Stocks certainly over bonds has been a decent place to be. And they're above their 200-day moving average. That can pull back quite a bit and still be above its 200-day moving average. And it's not the end of the world. So that's all I would say. I would say, when you're looking particularly at new highs, remember new 52-week highs or lows, if you're looking at on one particular day, it can give you some weird readings given short-term dynamics. I would think about, I talk about it in terms of expanding and contracting. I would try to think of it that way as well. Next question. Can you look at Dick's Sporting Goods? That's here, ticker DKS. I brought up this chart to help answer your question. The stock is going up nicely, and I would totally agree, but the AD line seems to be falling. Is this a bearish divergence? I wish I understood how accumulation distribution works. I will do my best to give you a little bit of color now, and then I'll show you where you can learn more about it if you're interested. Here's the chart of DKS on the top. This is the accumulation distribution indicator on the bottom in blue. And I agree with you, right? Overall, the trend in the stock has been higher. Overall, the trend in the accumulation distribution indicator has been higher, but that really changed in August. You saw how the stock gapped higher and then has really been sort of flat, hasn't made new highs in a couple months while the AD line has gone down. What does that mean? So a couple things I would say. Remember, this is different than when we talk about the accumulation distribution lines for the market. That's a breadth indicator looking at stocks and how many stocks are closing higher or lower on a given day. This is totally different. It's unfortunately named the same thing. It's called the accumulation distribution indicator. So sorry for that, but it is a different thing. This is an indicator created by Mark Chaikin, and his goal was to improve on the way we understand volume. One of the ways people look at price versus volume is they have the price of the stock and they have a volume bars below the chart. So they're looking at the daily volume reading. The problem with that is it's sort of looking at a bunch of individual observations. It's hard to understand the trend in volume and how it relates to the price movements. What the accumulation distribution indicator does is it basically says, where did we close today versus the high and the low? And based on where we're at in that ratio, today's volume is counted a certain percentage in a running total. So if you have a big, if stock trades at the highs for the day, basically all of that day's volume is positive and the line goes higher. If the stock closes at the lows for the day, all of that day's volume is considered negative. So it's a way of looking at the movements every day and relating that to the volume trend. So in a normal environment, a stock going higher would probably see the advanced decline line, the accumulation distribution line, AD line, going higher, right? Going more positive, because you tend to have more, tend to have the stock closing higher on the day and heavier volume when you do that, because that's what's causing the upside in price. I would agree with you. It's concerning when you see a stock that is attempting to go higher. And I would say, I don't know if I would necessarily call it a divergence, because what a divergence really be is if that happened back here, if the price was going higher and the accumulation distribution line was actually going lower, because what that would tell you is that the price is going higher, but that there's a lot more selling than buying going on day to day. That would be a concerning pattern to see. At this point, it's certainly not ideal. You, in general, want to own stocks where the accumulation distribution line is going up, because that tells you there's better buying going on each trading day. Chart School is the place to find it. Go to Chart School right here and search for accumulation distribution indicator, and you'll get some information on that. Next question: potential cup and handle setting up on TRTN daily and weekly? Question mark. Let's see. So here's the chart of TRTN is the ticker. That it's Triton International. It's in the transportation services group within industrials. Is this a cup and handle pattern? Not really, and I'll tell you why. So what happened, the way you decide whether something's a cup and handle pattern is this: an ideal Cup and handle pattern kind of looks like this, where you have a rounded bottom like this, and then that's where it stops. You sort of have a rim of the cup, and then you have a shallower pullback that kind of happens down here, kind of down where the 50-day moving average is. That would be an idealized cup and handle pattern. So it's literally like a cup and a handle, and then breaking above that neckline, the rim of the cup is the signal that something's happening. So this is a little less than ideal. So I'd call this like a cup and handle like pattern. I think you could get away with, but I'd be careful to think of it that way, only because you really didn't set that resistance level. That's what's so meaningful about, I talk a lot about big base breakouts, right? A stock that's in a basing pattern and then breaks out. And that means there's a consistent resistance level, and then you've broken above it, right? The chart of Netflix, when it finally gets above resistance, Amazon back in July, when it broke out of that base is really compelling. This one, not as much of a base, only because we didn't really test that resistance level only once, and we kind of broke right through it. However, is that level important? Absolutely. And I would say that 60 handle, which is sort of the rim here from March, that's where we broke out there in October. We've pulled right to it. That is certainly an important level to do. So could I call it a cup and handle pattern? Absolutely. But probably not. Would I consider that a bullish setup above 60? Probably. That's it. Boy, I wish we could. Let's ask him one more. 407 NASDAQ stocks hit a new 52-week low today. Worst reading since late March 2020. Yep, that March. What is up with this? So it's interesting, and I wanted to just share this one chart with you. You'll notice when I look at new highs and new lows, I tend to look on the New York Stock Exchange, and I look at the S&P. I rarely add this third one, which is the NASDAQ. And if you look at the NASDAQ composite, here's why. There are always a ton of new lows on the NASDAQ. And so are there a ton of them today? And you sent this question earlier today, I believe. Are there a ton of new lows? Absolutely. Is it more new lows than we've seen in a while? Of course. Are there always a lot of new lows? Much more than you'd probably expect. Yeah. And the reason is because the NASDAQ, especially the NASDAQ composite, has a lot of junky stuff in there. If you look at some of the worst performing names, there's a lot. Some things like the S&P 500, fairly stable companies. You don't get a lot of just noise from the signals as much. If you're looking for noise, the NASDAQ breadth indicators, pretty tough. So I rarely look at breadth on the NASDAQ because of that reason. There's just a lot of stocks that are not great companies that are listed on the NASDAQ that skew those indicators a little more negative. Now we will go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one, we're going to hit on 3 ratios today. Number one, the equal weighted S&P versus the cap weighted S&P. I showed you in the wrap the week segment how this ratio is rotating lower. It's making a new 6-month low this week. And what that tells you is, again, within the S&P 500, which are mega cap, large cap stocks, the lower end, the smallest companies, which are still pretty decent sized, are underperforming the largest names. And this is what tends to happen when the FANG trade is working really well, is this ratio will go lower. And that seems to be the environment we're seeing now. That's a very important chart, I would argue, to pay attention to going forward, because leadership is key. And you're seeing technology do very, very well right now. That's reflected on chart number 2 here as well. This is pure growth versus pure value. A lot of people do a ratio just looking at growth versus value. And while they're similar right now, the challenge I've had with that ratio is that it double counts, right? Some stocks like a Microsoft are considered both growth and value. It double counts a lot of names that are sort of kind of both-ish, right? In the middle. What this does is it has a pure list. Stocks are either growth or they're value, and they're separate lists. They don't overlap at all. So you're really getting a read of the growthier stocks versus the more value-y stocks. And those are not adjectives, but I made them that way just now. So you see this ratio breaking out, and the growth versus value ratios, most that I'm looking at are breaking out as well at the end of the week here. And what that tells you again is that investors are rotating into technology, they're in consumer discretionary. Those are 2 sectors we've talked about quite a lot. And when we've talked about the renewed strength in cyclicals at times, I would never tell you to be selling something like technology that's working. And what I'm seeing in those sectors is the charts are continuing to work. That's why this ratio keeps going higher. And I think that's a very important theme to be paying attention to through year end and certainly beyond. Finally, semiconductors making a new multi-year high this week. The SMH, NVIDIA breaking higher, many others as well. Screen that list and look for opportunities if you've not. I think those are fairly strong charts to be aware of and to be following. Trends should be trusted until proven otherwise. Folks, that is our show and a wrap for this week on the Final Bar. Really appreciate you joining us every weekday after the close for our show. As a reminder, all of our previous interviews on our YouTube channel, also our on-demand platform, StockCharts TV on demand. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a fabulous weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.